Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight within corporate filings. Today we're diving into Fidelity's latest shareholder report, and let me tell you, the numbers, especially in the cash central funds, paint a really interesting picture of where the money is flowing. It's almost like looking into a crystal ball for big money, but let's see if it's crystal clear or a bit foggy. And hey, if you find this kind of in-depth financial analysis useful, make sure you smash that subscribe button and join our community on Discord. The link is in the description below. This report covers Fidelity REVERE Street Trust, and it lays out the financial health and investment strategies of several Fidelity funds. We're going to focus on the core numbers that really matter, cutting through the jargon to see what's making this trust tick. Their financial year ends on May 31st, and this report is for the period ending May 31, 2025, giving us a snapshot of their performance right up to the present day. First up, let's look at the sheer scale of these operations. The Fidelity Cash Central Fund alone manages a staggering $55,070,076,000. That's a lot of zeros and a serious amount of money being managed. This is not your typical savings account, folks. This report shows these funds are dealing with massive amounts of cash. Now let's see what they are actually doing with all that money. One of the most interesting tables shows how the money is spread out. For example, in the Fidelity Cash Central Fund, 78.2% of their assets are in repurchase agreements. Think of repurchase agreements or repos as very short-term loans backed by government securities. It's a way to earn a little bit of interest safely overnight or for very short periods. They are holding over $43 billion in these repurchase agreements. This is a huge chunk of this fund's assets. It tells us they are being very conservative and prioritizing safety and very short-term liquidity with most of their money. Alongside repos, they have about $10.2 billion in US Treasury obligations. These are essentially loans to the US government, considered one of the safest places to park money. The fact that almost all of their investments are in these super safe short-term instruments, mainly repurchase agreements and US Treasuries, tells us a lot about their strategy. They are acting like a very secure parking lot for a massive amount of cash. Now, something really interesting here, across these funds, the total advisory fee is reported as zero. This is quite unusual. It likely means these fees are handled at a higher corporate level or through different arrangements, not directly itemized here per fund. It's worth noting that while these specific funds report zero advisory fees, the overall management of such vast sums of money undoubtedly involves significant costs elsewhere. Let's switch gears to the Fidelity Securities Lending Cash Central Fund. This one is managing over $31 billion. Very similar to the Cash Central Fund, about 78.6% of their assets are in repurchase agreements. Again, the focus is on safety and short-term liquidity. They have $24.5 billion in repurchase agreements, with the collateral for these agreements being US Treasuries. This just reinforces the conservative safety-first approach. When you're managing money market funds like these, the number one priority is preserving capital and providing easy access to cash, not necessarily chasing high returns. Then we have the FE Municipal Cash Central Fund, which is smaller, around $4.2 billion. Here, the investment strategy shifts slightly. About 69.2% is in variable rate demand notes or VRDNs, and 28.9% is in tender option bonds. These are still relatively safe short-term investments, but they are often tied to municipal projects, and VRDNs in particular can be reset daily, meaning their interest rate can change frequently. The fund holds over $2.9 billion in these VRDNs, and the list of specific bonds is quite extensive, showing investments across many states and municipalities. This is a key difference from the other funds we looked at, catering to investors who might have specific tax considerations. Finally, the Fidelity Tax-Free Cash Central Fund with about $2.4 billion in assets. This one is heavily invested in tender option bonds and variable rate demand notes, specifically municipal bonds. Notice how the investment focus changes to tax-exempt instruments when we look at this fund. With over $661 million in tender option bonds, the strategy here is clearly aligned with providing tax-advantaged income. The detailed breakdown shows investments in many states, highlighting the diversity within the municipal bond market. Now, digging into the financials themselves, for the Fidelity Cash Central Fund, for instance, the net investment income for the year ended May 31, 2020, $8 billion. That's immense earnings from simply managing money market instruments. On a per share basis, that translates to about 4.76 cents of income per share. Considering most of these funds aim to maintain a stable net asset value of 1.00 per share, this income is crucial for their stability and for providing returns to investors. And we have the auditor's report for the Fidelity Cash Central Fund. PricewaterhouseCoopers LE signed off on these financials for the tax-free Cash Central Fund and the Municipal Cash Central Fund. Deloitte & Touche LLP gave clean opinions, which is standard for these types of filings. The fact that these reports are signed by major accounting firms adds a layer of credibility to the numbers presented. From a Warren Buffett perspective, what we're seeing here is a massive, incredibly liquid and very conservatively managed pool of money. These aren't growth funds, they are stability and liquidity funds. The story here isn't about explosive growth or bold investments. It's about being a reliable safe haven for large sums of cash, earning a modest but consistent return through short-term lending and holding very safe government or high-quality corporate debt. The strategy is about precision and scale. They are leveraging their size to manage enormous amounts of money safely, likely for institutional clients, other Fidelity funds, or very large cash reserves. The fact that advisory fees are not explicitly itemized at the fund level, but the sheer scale of management is evident, suggests the highly integrated and efficient operational structure within Fidelity. In terms of strengths, the safety and liquidity of these funds are paramount. They are built to preserve capital and provide immediate access to funds, which is a huge strength in uncertain economic times. The risks are generally low, primarily related to interest rate fluctuations and counterparty risk in repurchase agreements, but these are heavily managed by using highly collateralized and short-term instruments. The direction here is clear: stability and capital preservation. The opportunity lies in their ability to attract and manage vast amounts of assets, turning that scale into consistent, albeit modest, returns. The weakness, if you can call it that, is the low return potential compared to more growth-oriented investments, but that's not the point of these funds. So to wrap up, these reports show Fidelity's vast capabilities in managing large-scale, low-risk cash assets. They are the bedrock for a huge financial ecosystem, providing essential liquidity and stability. It's a quiet but incredibly important part of the financial world. What's your take on these massive cash management operations? Do these conservative strategies impress you, or do you prefer more aggressive growth? Let me know what you think in the comments below. If you found this breakdown helpful, give this video a thumbs up and consider subscribing to Corporate Decoder for more unfiltered looks at how big business really works. And don't forget to join our Discord community for even more insights and discussions. Thanks for watching, and I'll see you in the next Decode.